Okay, this is part 3 of chapter 7. We start by looking at the reason why we say stocks are risky. It is riskier than when you put your money into the saving account or bond, but it comes with higher return, right? High risk, high return. First of all, company profit come after the company had paid everyone else, including bondholder. So if you are stockholder, you get paid the last they whatever they get in terms of revenue, they have to pay debt first, which is the bondholder, right? Stocks are risky because shareholders are residual claimants. They are paid last, and they will never know for sure how much their return will be. But in terms of bond, you have some certainty that if you have the face value and the interest rate on that agreement, you will definitely get the payment if the company is still there, right? Bondholder receive fixed nominal payment and are paid before the stockholder, even in the event of bankruptcy. Let's take a look at one example to see why stocks are holding some stock are riskier than other. A software business, let's say we have a software business, they need one computer that costs $1,000. This purchase $1,000 can be financed through stock or equity and bond. If the interest rate on bond is 10%, each $100 borrowed from the firm must pay $10 in the interest, right? Assume that the company earned 160 in a good years and $80 in bad years. With equal probability, which means 50% chance that they're gonna get good years, and another 50% chance they are going to get bad years. What happened to the company equity return? So we're focusing at the return on the equity as its level of debt changes. So this is table from your textbook, table 8.3. It shows the different combination of how you finance that $1,000. The first one, you raise the funding through the equity 100%, so no borrowing. The second combination, you raise 50% from the equity and another 50% you borrow, so borrow $500, right? And then another combination is 30% in equity and 70% borrowing, and 20% equity and 80% borrowing. Okay, so let's see how much will be the return and how much standard deviation will happen for each combination of investment. Standard deviation represent the owner's risk. So the more debt, the more leverage, and the greater the owner risk measured by standard deviation. First of all, you can see that expected return here of your equity is higher, right? When you have more debt, but also you will have higher risk as well, from 4% chance to from 4% deviation. Deviation is how much it can move away from the mean term, right? So this is 4, and the last combination, which has the most debt percent, has the greatest risk among all. So the first one, there is no borrowing, there is no payment to the bond, right? Whenever they get into the bad year, you get $80 back and 160 in a good year. In terms of return, it is 8% or 16%, return, right? 160 come from that from $1,000, right? So 50% chance of 8 plus 50% chance of 16, that will be 12% expected return, right? And if you, well, you know the mean already, you can calculate the standard deviation. The mean is 12, right? And calculate the standard deviation from these two, 8 and 16, you get 4 as the standard deviation. Another combination, you borrow 50%, $500, right? So at the end of the maturity date, you have to pay back 10% of that, 10% of $500. That is $50. So in the good year, you get 160, but you have to pay back $50. The net profit will be 110. And the bad year, you get $80, but you have to pay back $50 for sure. That will result in greater standard deviation, greater risk. How do you get 6% here? 6% come from 30 out of 500, right? Why it is 500? Because you put 500 in the equity. Yeah, times 100. That is 6%. 22% come from 110 divided by 500 times 100. So 50% chance that it's going to be 6% equity return plus another 50% chance that it is going to be 22% return. The central point or expected equity return is 14. And if you calculate the standard deviation, how much it deviate from the mean, 6 is far away from the mean, right? The mean is 14. So that's why standard deviation is higher to 8%. You do the same thing for all of these combinations. The last one, at the end of the period, you have to pay back $80 because you borrow $800. 80% out of 1,000 is $800. So 10% is $80 back. So in the bad year, what you're gonna get, it's $80, right? But you have to pay back to the bondholder $80. That's why you get 0 return. If you are lucky and the company was in the good year, 160, you have to pay back $80. So you get back 80, right? You have $80 over $200 in equity times 100, right? That will be 40% return. So halfway between 0 and 40% is 20. It is very high expected return, but it comes with very high risk as well. So that is how you consider why the stock are risky, right? And if you go further than that, if the firm were only 10% equity finance, the stockholders' limited liability could come into play. So you have to issue $900 worth of bonds to finance that $1,000, right? And you make promise to pay 10% to the bondholder. So you promise to pay $90 in the interest payment, right? If it is the bad year, you get only $80. It is not enough to pay the interest. And the stockholder actually would lose their initial $100 investment and the firm goes bankrupt. Yeah, from that reason, there are a lot of risks when you hold a stock. The stockholder require compensation for the risk they face. To integrate the risk into the stock valuation, we had the cash flow from that come from the dividend in the future before, right? The investor, well, we're gonna go to another part of the model. The investor will buy a stock with the idea of obtaining a certain return, which includes the compensation of the stock's risk. So we had the Gordon growth model before, right? Gordon growth. Oops. Gordon growth model. We think that the dividend can have some growth, right? D0, 1 plus G or D1. Discount back by K E minus G, right? K E minus G. Since we know that the investor needs some compensation for the risk, so it's something in their mind. It is something that has to do with KE. So we can think of the required return, KE, as the sum of the risk-free return. Risk-free return is the the interest rate from US Treasury bond. That's called the risk-free thing. And also the risk premium, plus the risk premium, which come from the equity. So required stock return, or KE, can be divided into two parts: risk-free return, RF, and risk premium. And we replace KE with RF and RP in the Gordon growth model. So you get the new one here. Now, if the risk premium is higher, this part is higher. There's a lot of risk in the economy, let's say that. What happened? The whole term will drop, right? If risk is higher. That's why you see the stock price drop a lot whenever the macroeconomy or whenever there is a bad news about that specific company. So the implication of the dividend discount model or Gordon growth model is the same thing. With risks are the stock price are high when the dividend are high, or D0 or D1 is expected to be higher. Dividends are expected to grow quickly, or G is high. The risk-free rate is low. The P0, right, is D1 over F plus P minus G. So whenever this amount is higher, G is higher, right? The whole term here will be lower, and then the price will be higher. That is from this implication. Dividends are expected to grow quickly, then the stock price will be higher. The risk-free here, if it is low, that means the whole term will be lower and the price will be higher. Risk premium, if it's low, the price will be higher as well. So, example, assume that the long-term risk-free real interest rate have an average of around 2%. So RF is 0.02. Historical information also suggests that the risk premium of this company is around 4%. So RP is 0.04. Dividend growth rate is about 2%. G is 0.02. Dividend today is 69, 0.64. So in the future, you expect it to grow, right? So it's 69.64 here. The growth rate is here. And then risk-free, risk premium, G. The price of the stock should be 1,776. If the market turn out and the price is lower than that, you are willing to buy it if you want. But if the price is higher than that, you are not going to buy it because the expected cash flow is not worth it. Okay. What happened when the monetary policy change to the stock price? Okay. How does monetary policy affect the stock price? Okay. First, the Fed lower interest rate, right? Monetary policy. Money market in the previous chapter. Money demand, right? Quantity of money and interest rate. Money supply increase. The Fed is lower the target interest rate. Right? The return on bond and alternative asset to the stock decline. Investors are likely to accept lower required rate of return on the investment in the equity, or if you want, F is lower in this sense. So KE is lower. When KE is lower, what happened? Price is D1 over right? This one is lower. The price is higher. That is why whenever the Federal Reserve announced that they're gonna cut the interest rate, normally the reaction of the stock market will be higher price because that is a signal that the Federal Reserve want to stimulate the economy. Also, another variable that can change when you think the economy will be expanding is the growth rate of the dividend is higher. Risk-free is lower, growth rate is higher. The whole term here will be lower, right? That's why price will be higher. What happened during the global financial crisis in 2008? So it started in August 2007. It led to one of the worst market in market crisis in the past 50 years. And I'm not sure about COVID-19 though, maybe it's worse. The subprime financial crisis led to a downward revision of the growth. So what happened here is G is lower for every company. The dividend growth doesn't look good anymore. So it lowered the dividend growth rate in the Gordon model. it results in increase in the denominator, right, which lead to decline in stock price. Also, uncertainty and widening credit spread also raise the required return on investment in equity. KE is higher. When KE is higher, that means the stock price is lower. KE, inside KE, you have risk-free and risk premium, right? F, A, A, F plus RP minus G. The growth rate is dropping. Risk premium is higher, so the whole thing is lower. That's why the stock market crashed during that time. Okay, so next part we will take a look at the theory of rational expectation to explain how people expectation have the effect to the stock market price.